Controlling your tax bill in retirement is one of the most overlooked pieces of preparing to retire. And depending on your income sources and the accounts that you use to save for your retirement, you could be setting yourself up for quite the tax bill. In this video, we're going to get into the tax consequences of those retirement income streams and the things that you should be considering as you build your retirement income plan. Stay tuned. Welcome back to Financial Wellness Planning. My name is Derek Coffey, and I'm the founder of FWP. And throughout our Preparing for Retirement series, we have gone over the most common sources of retirement income. We've gone over Social Security, we've gone over pensions, and we've also gone over withdrawals from a pre-tax retirement account. And in those videos, we briefly touched on the tax consequences of each of those retirement income streams. In this video, we're going to lay it all out as one. The retirement income that you're eligible for is going to be broken down into three different categories depending on how it's taxed. The first one that we're going to go over is the income that's going to be taxed at 100%. And what I mean by that is that all of the income that you receive from these sources, you're going to owe taxes on. The first one we're going to cover is a pension. If you are eligible for a pension, then you are going to owe ordinary income taxes on that full amount. And if you live in a state that collects taxes on income, then you're going to owe them as well. So if you live in the state of Virginia like I do and you receive a pension, then you can automatically assume that 5% of that payment you receive is going to the state. The second 100% taxable source of income in your retirement is anything from a pre-tax account. This could be a 401k, a 403b, a traditional IRA, anything that the government allowed you to save money into on a pre-tax basis. All of the money that you withdraw from that, you're going to owe taxes on. So at the federal level, you're going to owe those ordinary income taxes. If you live in a state that collects income taxes, you're going to owe taxes to the state as well. The one caveat about a pre-tax retirement account is you will incur RMDs, or required minimum distributions. And what this means is that since the government was nice enough to give you a tax break when you contributed money into the account, they're going to want their cut. And their cut comes in the form of a required minimum distribution. So once you hit your RMD age, the government is going to force you to take money out of that account. That way they can collect their taxes. And the reason that I bring RMDs up is because a lot of people retire and immediately begin drawing their Social Security benefit. They do this so that way their pre-tax accounts have time to grow. The problem with this is the RMD. At some point, you're going to have to take money out of that account. So pulling your Social Security and letting your pre-tax accounts grow may not always be the best decision. Let me explain. If you were to retire at age 62 with $250,000 in your pre-tax account, and you decided to pull your Social Security benefit and let that account grow, by the time you hit your RMD age, which for a lot of you watching this, it's going to be age 73, your pre-tax account could be worth $500,000. So how does that math work? Well, using the rule of 72, we can determine roughly when an account should double in value. So the rule of 72 is 72 divided by the rate of return that you receive. So if you were to receive 7% as your average rate of return, we could anticipate your account doubling in just over 10 years. Well, if you retire at 62 and your RMD age is 73, then the $250,000 that you retired with that grew at 7% over those first 10 or 11 years of your retirement is going to double. In our video on RMDs, we figured out how much a 73-year-old with $500,000 in their pre-tax account would have to withdraw as an RMD. And what we figured out is that RMD was $18,867, or roughly $19,000. If you've been living on Social Security alone for the first 10 or 11 years of your retirement, and then you all of a sudden have to add $19,000 of additional income, then you're going to be in for quite the tax surprise. If you're married, then controlling your RMDs becomes even more important. In a lot of cases, spouses don't pass away at the exact same time. There's going to be a period of time where one of you is going to be a single filer. Well, if you have to continue taking out $19,000 plus per year as an RMD, then the taxes that the single filer is going to pay is going to be significantly higher than what they were paying when they were married filing jointly. So as you build your retirement income plan, you need to take into account those RMDs, and you need to plan for what's going to happen to your surviving spouse when one of you passes away. The next category that we're going to go over is tax preferred. And what we mean by tax preferred is that the income you receive from these sources is not all subject to ordinary income taxes. The first type of income in this category is Social Security. And the reason this is because only 85% of your Social Security benefit can be subject to income taxes. Now, what we have to keep in mind is the equation that the federal government uses to determine how much of your Social Security benefit could be subject to taxes. That equation is AGI, or adjusted gross income, plus your tax-exempt interest, plus 1/2 of your Social Security benefit. Now, for most of the people that find value in my content, tax-exempt interest probably won't apply to you, but your AGI and your Social Security benefit will. Your AGI is going to be made up of anything that you receive from the 100% taxable category. So any pension income you receive, any distributions you receive from a pre-tax retirement account, all of that is going to factor into how much of your Social Security benefit could be subject to taxes. And what I want you to keep in mind is that the higher the percentage of your income that comes from the fully taxable category, the higher the percentage of your Social Security benefit that's going to be subject to income taxes. As you're building your retirement income plan, you need to take these things into consideration. It may seem like a good idea to take your Social Security benefit as soon as you can and let your pre-tax accounts grow, but it may not be. The RMDs that we discussed earlier could create a situation where the majority of your Social Security benefit could be subject to income taxes. Having your Social Security make up a greater portion of your retirement income is going to keep your tax bill lower. The second income source in the tax preferred category is a taxable investment account and the money that you have in the bank. Now, banks are pretty straightforward. The money that you've put in has already been taxed, so the only taxable events that are going to occur within that account is any interest that you receive from the bank. Now, keep in mind, any money that you receive as interest from the bank is going to be taxed at your ordinary income tax rate. But if you don't have a significant amount of money in the bank, then it's not going to make a meaningful impact on your taxes. With taxable accounts, there's a couple more moving pieces. The first thing that we have to take into account is interest and non-qualified dividends. So interest, just like the bank, if the institution that you have your money invested with pays interest on any cash that's in your account, you're going to report that as ordinary income. We also have to consider non-qualified dividends. Non-qualified dividends include dividends received from a foreign company that's not listed on the NASDAQ or the NYSE. It could also include dividends that are received from a REIT, a real estate investment trust, or a master limited partnership. It could also include special dividends. So if a company declares a special dividend, it may not always be considered qualified. So with interest and non-qualified dividends, you're going to owe ordinary income taxes. The next thing we need to go over is short-term capital gains. And a short-term capital gain is a gain that you receive on anything that you owned for less than a year. So if you buy a stock and you hold it for 6 months and you sell it for a profit, then any profit that you made, you pay ordinary income taxes on. The next piece is a long-term capital gain. And a long-term capital gain is on anything that you've owned for more than a year. So if you bought a stock, held it for 366 days, and then sold it for a profit, you're not going to owe ordinary income taxes on that investment. You're going to owe what's known as long-term capital gains taxes. And depending on your income, the maximum amount of that profit that could be subject to taxes is 20%. It's also going to be the same thing on qualified dividends. The maximum amount of taxes that you would owe on those dividends is 20%. Now, keep in mind, your accountant is who's going to guide you through this and determine what you owe taxes on. But from a 30,000-foot view, this is how a taxable account works. If you have a buy and hold strategy, then you can limit the amount of taxes that you're going to owe. If you have dividend-paying companies and they pay qualified dividends, then the income that you receive could be taxed at a much lower rate than your ordinary income tax rate. So this is what we mean by tax-preferred income sources. Social Security, only 85% can be subject to income taxes. Taxable accounts, only interest and short-term capital gains are going to be subject to ordinary income taxes. Long-term capital gains and qualified dividends are going to be taxed at a much lesser rate. The final category of retirement income that we're going to go over is the tax-free category. Now, for this video, we're only going to go over the Roth IRA and the HSA, or the health savings account. But the Roth IRA, if you're 59 and a half and your account has been open and funded for at least 5 years, then any of the money that you receive from that account is not subject to income taxes. And this can be a very powerful tool in your retirement when it comes to controlling your tax bill. If you have a year where you need to take out a little bit of additional income to cover maybe a major expense or an emergency of some sort, then the Roth IRA can fill that income gap and it not increase your tax bill. There is also no RMD related to the Roth IRA. The money that you contributed to that account was put in on an after-tax basis, meaning the government already got their cut. So the government's not incentivized to force you to take money out of that account. So you can set that account to grow as much as you want it to, and you never have to worry about it affecting your taxes. The final account type we're going to go over is the health savings account. And the HSA is the best kept secret of retirement planning. You get to put money in tax-free, the account gets to grow tax-free, and then if you withdraw the money for a qualified medical expense, then the withdrawals are also tax-free. Now, I'll put a link to the IRS form that explains what a qualified medical expense is in the description of this video, but that list is quite extensive. But with an HSA, you can use that money to cover your healthcare-related expenses in retirement and not increase your tax bill. If you remember from our video on the 5 most common regrets that retirees have, one of those regrets was not planning for their healthcare costs in retirement. For the average couple that's 65 years old, they could anticipate spending over $350,000 on their healthcare needs while they're retired. With an HSA, that can help cover some of those costs. So I've thrown a lot of information at you in a very short period of time, and only half of it may actually apply to you and your situation. So the easiest way to envision how these income categories work is with gears. And as obvious as it may seem, the more money that you have coming from that fully taxable category, the higher your tax bill is going to be. Now, if you receive a pension, then you're most likely going to be stuck in a situation that looks more like the left-hand side of your screen. There's nothing you can really do about it, but you can sleep better at night knowing that a portion of your retirement income is guaranteed. If you're not eligible for a pension and all you have available is a pre-tax account and Social Security, then your retirement income plan needs to look more like the right-hand side of your screen. But regardless of the situation that you're in, your retirement income plan needs to be built as tax efficient as possible. The only way to do that is to understand how the income that you're going to receive is going to be taxed. So find an accountant, find your financial advisor, get them to work together to build a retirement income plan that's going to work best for you and your situation. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you know someone that's getting close to retirement and they haven't built out their retirement income plan, then send this video to them. Maybe it'll help. But I thank you so much for tuning in. I'll talk to you soon.